Good morning, everybody out there in webinar land. We're going to get started in just a few seconds to give some of our registrants and participants some extra time to get logged in on this Tuesday morning. Now, before we get started, I'm going to give some housekeeping details. So first and foremost, this webinar is being recorded. So if you have to step away or leave early, don't worry, this is being recorded and we'll have it on our YouTube channel after this, and we'll send out notifications when that's available. We will be taking questions today, so please use the Q&A button feature up at the top. We want to make sure that all your questions are put in there so that we get to them in a timely manner. And then, of course, beyond that, we do have our lovely disclosures that I am going to put on screen and read out loud for everyone now. The content shared in this webinar should not be considered as financial, investment, or tax advice. Before making any investment or financial decisions, seek advice from professionals like personal financial advisors, tax advisors, or other experts who can provide guidance tailored to your specific financial situation. Insurance products are not insured by the NCUA and are not a deposit, product, or other obligation of or guaranteed by Texans Credit Union. By registering for this webinar, you consent to sharing your information with the event organizers and/or presenters. You also agree to receive communications from Texans Credit Union, its partners, and adhere to Texans Credit Union's social media and privacy policies. Insured by NCUA, Equal Housing Opportunity, NMLS number 530654. And that is all our housekeeping details for now. And now I'm going to turn it over to our guests.
Hello, everybody. Welcome. We are so glad you're here with us today. My name is Brittany Lilly, and I'm a CPA and partner here at Lawson Company CPAs. We are a 19-year-old CPA firm. We've got 2 locations here in Dallas, one in Richardson and one in Rockwall. One of the things that we do is we try and help taxpayers navigate things like retirement income, investments, life changes, and long-term tax planning. We know that for most people, taxes are very overwhelming and stressful. Our goal is to make taxes feel less overwhelming and more strategic. So understanding not only what you owe, but why, and in trying to help implement strategies to help lower your overall tax liability. I am joined by 2 others from our office. So Kevin Lawson, the other partner here at Lawson Company CPAs, and then Taylor Smith is our project coordinator, who is one that is always talking to the clients and make sure that we are following what we're saying and making sure that everything stays on track. So I'm so glad to be joined by both of them. And our presentation today is truly designed to give you a solid foundation and practical knowledge that you can actually use. We want you to be able to understand taxes at least a little bit. We're not asking you to be experts, but we're excited to walk through all of this with you today. So Taylor, if you can add the presentation, thank you so much. And we'll get started. So I think, Taylor, if you can move forward for me. Perfect. There's all our beautiful faces in case you needed to see them again. And then we'll get into the agenda. So our roadmap for today. So first, we're going to look at what's changed in 2025 from a tax law perspective. There were some changes that were implemented at the middle of 2025 that are going to affect everyday taxpayers. And we're going to go through and highlight a few that we feel are going to impact you guys that are important to know. Second, we're going to go through some of the top tax questions that we hear all the time. If you're wondering, how long should I keep my tax documents? Or is Social Security taxable? You are not alone, and we are going to go through and answer some of those questions for you today, along with some others, okay? The third thing we're going to do is talk through some common tax mistakes that people make. Knowing what to avoid can be almost as helpful as knowing what to do at times. So we're going to go through some of the mistakes that we see people make, and just to make sure that you don't get stuck in some of those things. Then we'll cover the practical strategies to help reduce your taxable income. This is where we're going to connect the rules of tax law to your everyday life. So retirement accounts, timing strategies, just ways to be more intentional about how you do things to kind of help you from a tax perspective. Then we're going to wrap up by looking at self-filing versus hiring a tax preparer. When does it make sense to do it for yourself, and when could it be helpful to have a tax professional come in and help you? And so we want to kind of, I know we're going to cover a lot, and taxes can spur a lot of questions. So as we go through, feel free to write down your questions. I know Josh said we're going to have time at the end for questions. So anything that spurs a question, write it down. We're happy to answer anything. So let's get started. And so before we go into the details, I just want to give you kind of a big picture snapshot of where 2025 is sitting. So Congress did pass a law that is referred to as the One Big Beautiful Bill Act, or OBBBA, that locked in some of the tax rules that were actually set to expire in 2025. So we as tax preparers knew that there was going to be something coming in the pipeline, whether that be get rid of something, change something, or just say, hey, we're going to keep this going a little bit longer. So on the next few slides, we are going to talk about some of those tax law provisions that have either been extended, changed, and or eliminated with this new bill that came out in July. So we'll start with some of the individual changes. So one key impact is the individual tax rate structure. So previously with the prior to 2018 and the tax law change there, the highest tax rate was 39.6%. That was set to expire at the end of 2025. With the new tax law, they have kept the top tax rate at 37% rather than jumping back up to 39.6. So that is good news for all. Everybody was hoping that was going to be the case, and that has been extended. So we are going to stick with the 37%. Also, the standard deduction amount, which for most people now you're taking rather than itemizing. That has gone up for single filers. It's going to be $15,750 and $31,500 for married filers in 2025. So that's going to continue to increase with inflation every year, but it is going to stay at that higher rate. So what we're going to see is not most, but a lot of people are still going to continue to take the standard deduction rather than itemizing. The next item, which a lot of people are excited about, is the senior deduction. So for taxpayers 65 and older, there is now a senior additional deduction that is available. So this deduction will cover tax years 25 through 2028. And you do qualify for over essentially a $6,000 deduction on top of all the other things you qualify for. If you are married filing jointly and both taxpayer and spouse are over 65, it does go up to $12,000. So each person does qualify for the $6,000 if you are over 65. Like I mentioned a second ago, this does stack on top of your other deductions. So this is not, it's not an either or with the standard deduction. If you qualify, you get to add it on top of your standard deduction. So you're looking at, if you're married, you're looking at $31,500 for your standard, plus potentially an extra $12,000, which is great. The other thing is, if you qualify for the extra standard deduction for your age or blindness, you get to add that on top of it as well. So you just have additional deductions stacking up on top of each other, which is wonderful. There is a phase out limit for income levels. So if you are married, you are going to start losing that $6,000 or $12,000 if you're married when your income is at $150,000, and it goes away fully once you're at $250,000. For single filers, it's $75,000 up to $175,000. So there is an income phase out to consider, but for a lot of people, this is going to be a really great benefit. And we'll get into it a little bit more later, but this will help supplement the tax on potentially on your Social Security. The next thing I want to talk about is 2 new temporary deductions that are especially important for people that have tips or overtime. Again, this is something that is going to cover 2025 through 2028. First, the no tax on tips revision. So for certain jobs that have tip based, right? So you think about restaurant servers or bartenders or salon workers, they can actually deduct up to $25,000 of their qualified tip income per year from their taxable income. This is subject to income limitations, of course. So if your income is a little bit higher, there's a chance of phase out. With most of these things, you're going to hear that. But it can be a really great benefit to some of those tipped employees that usually they are paying tax on all of their earned income. The second is the no tax on overtime provision. So if you're working extra hours, you actually have the ability to deduct up to $12,500 of qualified overtime pay. If you're married filing joint, it actually goes up to $25,000. Again, this is for 25 through 2028, so it will expire unless it's extended after 2028. Only the premium portion of the overtime is actually qualified. So you hear people say, I get time and a half. It's the half that qualifies. So it's not going to be all the overtime that's paid, but it is going to be that half portion. What that means essentially is you can have some of your income non-taxable. That's always going to be a benefit for any taxpayer. One thing that is important to know, though, is these things are not automatic. You have to have the records to show that you have tips and or overtime pay. Because this tax law changed in the middle of 2025, but it's eligible for 25, employers didn't know this was going to happen. So regulations and reporting requirements have not changed and won't change until really 2026. So it's really important for 2025, if somebody is wanting to take advantage of these changes, that you have the records to show. Most employers are either going ahead and calculating it and including it on the W-2s if they are available to. The other option is you can request information from your employer to be able to get that information. So just make sure from a planning perspective, if somebody in your household is working overtime or has a tip-based job, just make sure you keep your records, keep your last pay stub of the year, because that should show some of these items for you, just to make it easier when you're going to file your tax return. And then the last thing on here is planning opportunities, especially for people between retirement age and age 73. A Roth conversion is something that we talk, it feels like every day about somehow. But the Roth conversion is when you're moving money from a pre-tax account, like a traditional IRA, or say your 401k from your employer that you've now rolled into a pre-tax account. When you do this conversion, it has the ability to move money from a pre-tax account, pay tax now on it. We got to pay tax at some point, unfortunately. But you have the ability to then move it to a post-tax account that can grow tax-free. There is a lot of strategy that can wrap around this structure and this conversion. The big reason that this starts to come into play is because of required minimum distributions. When you turn 73, the IRS says, hey guys, you have to start taking money out of these pre-tax accounts because we want our money now. So what's nice is the Roth doesn't have that same stipulation because it's post-tax. The IRS already has their money. They don't care when you take that out. So it actually gives you a benefit to be able to strategize how you're receiving money in retirement in the most tax efficient way. So it's something that we see a lot of planning opportunities and have a lot of conversations surrounding. And I think truly and honestly can be a great conversation to have as you're planning for retirement. The next thing that we want to talk about is some of the deductions that are now available and or a little bit different than they were previously. So for tax years 25 through 28, again, if you take out a loan to buy a new personal vehicle, you actually could potentially deduct up to $10,000 a year for the interest you pay on that loan. Vehicle interest has never been a deduction. So this is kind of a new frontier for tax deductions. So it does have to be a new vehicle for personal use, and it does need to be under 14,000 pounds. Also, on top of that, the loan has to be secured by the vehicle. So you can't buy it on a credit card and then be able to write it off. Or say you get a loan from a family member. It truly does have to be a loan that is secured by the vehicle itself. But the benefit too is you can get this deduction outside of your standard deduction. So you can get your $31,500 plus your vehicle interest if you qualify. So it can, again, stack, which is really great. Once again, there is a phase out. So if you have 200,000 of income and you're married filing jointly, it does start to reduce from there. So it's just something to be mindful of those limitations. But if you're buying a new vehicle, keep that in mind. It could benefit you from a tax perspective. Another thing that comes up a lot is charitable contributions. And there's a couple different changes to be mindful of as you're thinking about your deductions. So for most people, and prior to 2026, you had to itemize to get a benefit for your charitable donations. Starting in 2026, that is actually going to be a little bit different. The IRS is giving us the ability to take $1,000 if you're single, $2,000 if you're married, regardless of if you itemize or you take the standard deduction. So if you're giving a little bit, say to your church or, charity of choice, but you haven't had enough to itemize in the past, you really haven't seen a tax benefit for this. But going into 2026, you actually are going to get a little bit of a benefit, which is great. One thing to keep in mind is this does have to be cash donations. You cannot donate non-cash, so clothing to Goodwill, things like that won't qualify. It truly does have to be cash donated. But it is another benefit that we're seeing, what we say above the line rather than predicated on taking itemized deductions, which is really nice. The other thing around charitable donations that we kind of want to talk about is there is a new limitation on your itemized deductions if you take them. So you still can take your charitable donations, which is great. But what's new is in 2026, there's going to be a floor to those charitable donations. So similar to how the medical deduction works, the first 0.5% of your income, you'll actually lose that in your charitable donation. So for instance, if you have income of $200,000, your first $1,000 given to charity will not actually give you a deduction. it'll be anything over that $1,000. The thing is, the contributions that you are not allowed to deduct because of that limitation can be moved forward into the next year. So it's not that you're completely losing them. It's just that you're not able to take them in that current year. They just shift to the next year. So it is something to be mindful of when planning your deductions, just to know that that is something that will be in effect. Now, for the charitable, both of these items do not start until 2026. So the tax returns you're working on filing right now for tax season are not impacted by these two items specifically. So keep that in mind. This is something we'll start planning for after we get through April 15th, then we're going to start thinking about it. Now, another just little caveat to the charitable donations, it does not affect your QCD. So if you are having your required minimum distribution sent directly to your charity, this limitation does not impact you. So keep that in mind as well. And that's also a good planning opportunity. The last item in terms of deductions is the child tax credit. I'm going to cover it pretty quickly, but for 2025, the child tax credit is $2,200 per qualifying child, up from $2,000, but up to $1,700 of that can actually be refunded. So if you don't have any tax liability, you could still qualify for up to $1,700 of that, whereas before you could not. So that's really, it's essentially just enhancing the credit, and it's a credit that was temporary and has now been made permanent going forward. But this truly does give families that have kids kind of a more stable and larger credit going forward, instead of the rules kind of constantly changing from year to year, which is really nice because then you have something you can really rely on. Now, the last thing I want to cover is some changes that impact businesses. There weren't a ton of changes. Mostly what we saw in the business side is reinstating things that were previous and or keeping things that have been benefiting small businesses over the last many years. So the first one is depreciation. The new law brought back full bonus depreciation and made it permanent. This means that any qualifying business property, so things like equipment or some building improvements, computers, some of these things that you're buying that are a little bit larger for your business to use and operate, you can actually now deduct all of that cost in the first year, rather than spreading it out over multiple years based on the life of that asset. Section 179 has also been extended. It has a $2.5 million limit for 2025. Bonus depreciation and Section 179 is very confusing for a lot of people. Essentially, both are giving you the benefit to deduct that expense in year one rather than having to split it over time, but they each have different rules. So bonus depreciation is kind of an all or nothing. You have to say, I want all of my assets to be at 100% or none of them. Whereas Section 179 actually gives you the ability to choose which assets are eligible and which aren't, which is really nice at times if you kind of don't need all of your assets depreciated. But it does become a good planning opportunity to decide which you're going to use and how you're going to use it. But either way, the benefit is there, and that 100% is huge for small businesses, especially because prior to the new tax law change, we were going down to 40%. So, now we get to take 100% rather than 40. So that creates huge planning opportunities for small businesses. And a lot of flexibility, because now you can decide, okay, do I need to put this in place for 2026? Do I wait till 2027? Gives you some better ability to plan for the future. The second item I want to talk about is the qualified business income deduction. So a lot of people hear QBI, so that's what it is. And that is under section 199A. So this deduction is a 20% deduction for owners of pass-through businesses. So if you have a small Schedule C or a partnership or an S corporation, you actually have the ability to take 20% of that income, and now it's non-taxable, which is great. I mean, for small businesses, this is a huge benefit. And it was set to expire at the end of 2025. The new tax law has extended it and made it permanent, which is huge for small businesses. And it's something that I think a lot of people were nervous were going to go away. So all the small businesses are rejoicing with this change. I have no doubt it's going to continue to be a big benefit for any small business. And it will be going forward, knowing that it's permanent. So it's something that they can rely on for years to come. That is all I have. I'm going to pass it over to Taylor, and she is going to start going over the top tax questions that we hear every day.
Yeah, so hi everyone. My name's Taylor Smith, as she said. I'm the project coordinator here at Lawson Company CPAs. And yeah, I get to go over some of these top tax questions that we hear probably every single day, as well as a few common tax mistakes that we see. So yeah, I'll jump into that. So starting off with, is Social Security taxable? That's one we hear all the time. And the short answer is that it depends. So whether your Social Security income is taxable really comes down to your total income. The IRS looks at all of your sources of income, things like retirement account withdrawals, wages, investments, and part of your Social Security income. And they add all that up to get an adjusted version of your income, and then they compare that to they compare that total to a certain income ranges that they've kind of preset for people with fixed income. And if your income is below those ranges, then your Social Security may not be taxable at all. But if your income is within the ranges they've set, then anywhere from 50% to 85% of your Social Security income can become taxable depending on where you fall at those ranges. And I always like to clarify that when we say up to 85% is taxable, that does not mean that you're at an 85% tax rate. It simply means that up to 85% of your benefits could be included in your taxable income and then taxed at your normal tax rate. So it's not automatically taxed, but it's not automatically tax-free either. So it really just depends on your overall income picture. And then taking a look at question number 2, will I get audited if I file an extension? That's another common question that we get. And the short answer is no. Filing an extension does not increase your chances of being audited. In fact, there have actually been studies showing that taxpayers who file extensions are slightly less likely to be audited. We often tell our clients that, hey, it's actually really great to go ahead and file that extension because, life happens, maybe you don't get a form on time. And so it's just better to have that safety net. So yeah, we always encourage our clients to file an extension because it actually shows, it's shown that it can actually lower your chance of an audit risk. So yeah, we encourage that. And then the third question, is it better to get a tax refund or break even? That's another question we get a lot. And it's really a personal preference. When you think about what a tax return is, it's simply reconciling or comparing what you owed in taxes overall for that year compared to how much you've paid in towards that tax liability through things like paycheck withholding and estimated tax payments. So if you're getting a refund, it just means that you paid in more than you actually owed. If you break even, it means you paid in exactly the right amount. And if you owe, it means you didn't quite pay in enough during the year. So when you think about which one is better, it's really a personal preference because some people like to, get a refund because they treat it almost like a savings plan. They might use it to take a trip, make a big purchase, build savings, pay off debt. All of that is perfectly fine. And then other people prefer to break even because they don't really love the idea of overpaying and essentially giving the government an interest-free loan. So neither option is really inherently right or wrong. It's just about kind of taking the approach that aligns with your financial habits and goals. So that was question number 3. And then question number 4 on the list, how long should I keep my tax documents? So for most people, the safe and simple rule of thumb is to keep your tax returns and your supporting documents for 7 years. Sometimes you'll hear 3 years mentioned, and that's just because the standard IRS audit window is about 3 years, but there are exceptions that can extend that time frame. So at 7 years is just a safer number. There are a few things that you should keep for longer. And so those things are like keeping your tax returns. You should actually keep your actual filed tax returns forever. They can come in really handy for things like loans, planning, any questions that may come up like many years down the road. So we definitely encourage you to keep your actual filed tax returns forever. But you also want to keep things like anything that establishes your cost basis in properties and investments. You want to keep those for as long as you own the properties or the investments and for several years after you sell them. So that includes things like purchase documents, maybe major home improvement receipts, investment records, because those things directly affect how much tax you may owe when you go to sell those items. And also for business owners, core accounting records are typically kept indefinitely with supporting documents. You retain those for at least 7 years. So keep the general records for indefinitely, but then keep those supporting documents for 7 years. And then moving on to the next slide, some more top tax questions. So the first one on this page, why do I owe taxes this year when I never used to? So that's another one we get a lot. And it really, if you owe taxes on your tax return all of a sudden, out of the blue, seemingly, and you didn't used to, the answer is that something has likely changed, right? So maybe your income increased. Maybe you had bonus income or side income. Maybe you got a side gig. Maybe your spouse's income changed. Maybe you had a big life event, but didn't update your withholding on your paycheck. Or maybe there were some tax credits that you used to qualify for that you phased out of because your income went up. So all of these things kind of go back to earlier when I said that, your tax return is kind of just a reconciliation of what you owed versus how much you've already paid through withholding or estimated tax payments. So if you owe all of a sudden, it doesn't necessarily mean that something was done wrong on the tax return. It just means that you didn't quite pay in enough because something changed. But the good news is that it's fixable for the future. You can always increase your tax withholding or your estimated tax payments so that there aren't surprises in the future. And then the next one, why do I owe taxes on investments even though I didn't receive any of the funds? The reason is that the IRS taxes certain investment activity when it happens, not necessarily when you take the cash out. So for example, if you're invested in mutual funds or certain brokerage accounts, you may receive dividends or capital gain distributions throughout the year. And even if those amounts aren't automatically reinvested and you never actually saw the cash hit your bank account, the IRS still considers that a taxable event. So it's not about whether money landed in your checking account. It's about whether a taxable event occurred inside the investment account. So it's something to really keep in mind when you are, when you have these kinds of brokerage accounts or any mutual funds. It's something to keep in mind that you need to be mindful of the tax implication of any sale or any stock sale or anything like that. It's just something to keep in mind as you're doing that. And then another question, do online tax filing tools like TurboTax work well? Yes, the short answer is yes. They can work very well for simple tax returns. If someone has a W-2, maybe some basic interest income, they take the standard deduction, and they don't really have a lot of other complexities, those tools can absolutely get the job done, no problem. They're designed to walk you through questions step by step, and for straightforward situations, they're perfectly great. And where things start to get tricky is when life gets more complicated. So if you're self-employed, if you own a business, if you have a rental property, investment sales, or maybe you just have some major life changes. That's usually when being more proactive and having a professional involved can make a difference. So it's less about whether the software works and more about how complex your situation is. And then the last top tax question, and the one, this is the most common question that we get, is how do I reduce my taxes? And I get it. This is a big question. Who wants to pay more in taxes? Nobody. So we're actually not going to cover that right now because we will cover it in a few slides. So I'm going to leave you in a little bit of suspense on that one, but Kevin's going to cover it in just a little bit. So we'll move on to getting into some of the common tax mistakes that we see. So, we've talked about some of the common tax questions that we hear, but what are some of the, the common mistakes people are making? You'll see on this slide, relying on social media and relying on AI for tax advice. These are relatively new, right? Like these, especially AI is pretty new. But we're seeing a lot of this across the board. So, as far as social media goes, you're scrolling and you come across someone who's confidently telling you about this tax loophole that they've used that saved them a ton in taxes. And that may be true. They really might have saved a lot in taxes, but the problem is that tax advice is highly individualized. So what works for one person may not apply to you at all. And social media really just gives you that full context, right? So we've seen situations where someone implemented a strategy that they saw online and it ended up costing them more in penalties and interest and administrative fees than it ever saved them because it wasn't really right for their personal tax situation. So it's not that all information online is wrong. It's just that tax planning depends on a lot of moving pieces. Things like your income, your filing status, the state you live in, if you own a business, your business structure, your long-term goals, and many other variables. So you just really have to be careful and really dig into that nuance there. It's also worth pointing out that there are some videos out there that would land you in jail if you followed their advice. We were actually planning to play a video, but we couldn't get the tech to work out. But we were going to play a video that the advice that they were giving in that video was completely illegal. So it would have actually landed you in jail if you tried to follow their advice. But they were very confident. So it seemed legitimate if you didn't know what you were talking about. So I think our advice on social media is that if you hear something that sounds like a great tax strategy online, just pause, run it by a qualified professional who can evaluate whether it actually applies to your situation, because we want to make sure that it's right for you. And it's similar, right, with AI. So that's a big thing that has popped up, especially in the last year or two, that we're seeing a lot. So it's tricky because people are really starting to rely heavily on their favorite AI tools like ChatGPT, Grok, all of these that are out there. And I'm right there with them. I love ChatGPT. It's fast, easily accessible, and usually pretty reliable. But the problem we're seeing is that AI usually doesn't have all the information it needs to evaluate the nuance of your tax situation. I know I have personally seen a huge uptick in clients coming to us with advice that ChatGPT or other, AI platforms gave them. And the advice was good for someone, but not for the person that was asking about it. So that's kind of the tricky part, is that it has access to the tax codes and the tax laws that are out there. So usually the advice is not inherently wrong, but it's wrong for that particular person. It's not seeing, the AI is not getting all of the nuance, all of the different situations that you have going on. And so now I have a slide here kind of giving some real examples of, bad AI tax advice that we have personally seen. The first one, form an LLC and you'll pay less in taxes. That one is actually completely inaccurate. That one actually, an LLC it only provides legal liability protection. It doesn't provide any tax savings. Now, if you own a business, there are some tax savings that can be had, but simply creating an LLC is not a tax strategy. So that one, if you just take it at face value, it is not correct. And that was something that a client sent in recently. They said, hey, ChatGPT told me I could do this and it would save me in taxes. What are your thoughts? So that one's just completely incorrect. If you look at the rest of these on this list, all of them are actually good tax strategies for someone, but the particular clients that that actually sent these to us were not good matches for those strategies. So, if I have a main takeaway to give to everyone here today for, AI advice and social media advice, it's just to kind of pause and run it by a qualified professional who can kind of evaluate whether that advice is actually good for you, good for your tax situation. So those are a couple of common tax mistakes that we're seeing right now. And then Kevin is actually going to take it over from here and go over some more common tax mistakes. So Kevin, you are up.
Thank you, Taylor. I'm Kevin Lawson. I'm also a partner with Lawson Company CPAs. And continuing on with the theme of common tax mistakes that we see. Life changes. There's always things that take place that are different. Kids are born, kids grow up, kids go to college, new jobs, loss of a job, retiring, greater income, lesser income. These are all things that change in all of our lives. One of the mistakes that we often see is not updating your withholding. We see people get married, people have kids, and they're still withholding at the much lower tax rate as they did when they were single, for example. So as life changes, keeping in mind, hey, what do I need to do in terms of my withholding from my paycheck to make certain that I'm on track? Taylor mentioned a moment ago, is it better to get a refund, owe money at the end of the year, or break even? Most of our clients like to break even or get back a little bit. So we want to make certain that by updating withholding, we're pretty close to that breaking even. This is one we see quite a bit. Those who receive stock options, RSUs, stock grants from their companies, we see so often where they have a huge tax bill at the end of the year and say, well, why is this? Companies typically withhold a straightforward 25%. It's exciting because you've received a huge grant of stock, which is converted oftentimes immediately into cash. You get a big cash windfall. And then at the end of the year, they realize, oh no, I owe a lot of tax. Making certain you're withholding on your stock compensation is in line with your actual tax bracket. That's something we help a lot of our clients with. It's an important question to ask throughout the year when you're actually granted stock and not waiting until the end of the year. We see a lot of side hustles. A lot of people have side income, money coming in from whether it be working a second job, whether it be selling Mary Kay, whether it be doing real estate on the side, whatever that side hustle is, a lot of people are getting 1099 income. And the receipt of that 1099 income, when people file their own tax return, oftentimes they don't even report it. It's inconsequential. It's really small. I don't have to worry about this. The IRS gets a copy of how much you received, and if they don't see that on your tax return, you get a love letter from our friends in Washington that says, hey, you owe some additional tax. So be very aware of the various types of income that you're receiving. People who receive a lot of money from Venmo, if it's coded as business, that comes across as 1099 income and is reported to the IRS. Estimated tax payments. This isn't just for retirees anymore. Talking about that side hustle income or other sources of income or stock compensation. If you have additional income that goes well beyond your normal W-2 wages, you should be making estimated tax payments. This way you're keeping up with tax. And the reason to make the estimated tax payments, it avoids penalties. I'm a huge believer that any penalties that you have to pay are just completely, totally a waste of money. We pay the IRS enough as it is. Why in the world would we want to pay additional penalties? And this is absolutely the easiest way to go right past that. avoid those penalties, and make certain that you're keeping up with tax throughout the year. It's also an easy way to get right to breaking even at the end of the year, not having a lot of tax due or a huge refund at the end of the year. One of the things that Brittany had mentioned earlier that I want to bring up is the required minimum distributions. When you hit 73 years of age, you got to start taking money out of your retirement account. The IRS requires that based on your lifetime, you have to start taking money out of your account. And by account, these are all of your retirement accounts, whether it's a 401k, IRA, all of your retirement accounts, you have to start withdrawing funds, and it's based on your age and life expectancy. We see some people who don't even think about it and just they've never had to take money out of their retirement account and they miss taking it out. There's penalties for not taking out retirement funds at the minimum rate. So check with your CPA or financial advisor to walk through, hey, how much do I need to take out? At that same age, a lot of times people take unexpected monies from those same retirement accounts. Kids go to college, you decide, hey, I want to take my family on a vacation. How are we going to pay for that? Well, let's take money out of a retirement account. It's a great way to pay for some of the unexpected things in life and making certain that you're planning for the tax side of it. When you take additional funds out of your retirement account, that could possibly increase your tax bracket. Based on wherever you are, what your normal income was last year, the additional funds, if it changes your tax bracket, you might find that you owe more money at the end of the year. We prefer to do the planning up front when you take that money out of your account. Hey, let's look at how much we're taking out. What does that do to your tax bracket? Where should you be in terms of those estimated tax payments? So that way, again, you're coming in pretty close to break even at the end of the year. We talked about it a minute ago, the side hustle income. This is just something we're seeing a lot of, and it's irrespective of age. We see 20-somethings, we see Gen Xers, boomers, generating side hustle income from a wide variety of things. One of the things that people forget to do, it's not just reporting the income, but when you have a side hustle, it's a great opportunity to take tax deductions. All of those expenses that people don't even think about, anything related to that side hustle becomes a deduction. So it creates a lot of tax planning opportunities to help reduce your overall tax. This last one is something we see this come up every now and again. Hey, I got a tax refund. Of course, my tax return is correct. Getting a refund means that my tax return is correct. It's really important whether you do it yourself or have your CPA do your tax return, take a look over it. Make certain everything passes the smell test. Make certain that it looks correct to you. Just to do a double check and have an idea as to does this really make sense? Understanding your tax return is important, at least from even a generic perspective, so that you understand what you can do to make additional changes in your tax life that's going to help save you money in tax. That becomes really important. Taylor mentioned it earlier, and I want to make certain that we go over, here's some things that people can do to reduce their overall taxable income. One of the things that we hear from all of our clients on a regular basis, Kevin, I want to reduce my tax. I pay way too much as it is. What can we do? Depending on your tax situation, some of our clients have a huge opportunity to take deductions. Other clients have less opportunity. Let's talk about which is which and why some have more than others. Those who have 2 W-2s, home mortgage interest, 2 dogs, 2 kids, there's some limitations as to what you can really take as deductions. If you have a business, suddenly the whole world of tax deductions is opened up and creates a ton of opportunities. Let's kind of walk through some of those. Leveraging your tax deductions really becomes one of the easiest, most important things that you can do. Make certain we're taking deductions for real estate tax, home mortgage interest, charitable donations. Some of the new tax laws that Brittany spoke about earlier, for example, taking deductions for charitable donations, qualified charitable donations. We'll come back to that in a moment. These are some really easy things to help reduce your overall tax. Taking advantage of some of the tax credits. For example, education credits like the American Opportunity Tax Credits. My kids just graduated from college and we are abundantly familiar with the American Opportunity Tax Credit. These are education credits that you can use that literally save thousands of dollars. Hugely important. You definitely want to look more into those. Tax advantage accounts. This is one of the easiest things you can do and one of the most important things you can do. Making contributions to your IRA, your 401k. My grandfather told me when I was a little kid, and it didn't make any sense to me at that time, but it certainly does now. It's not how much you make, it's how much you keep. It totally makes sense to me now. And using your IRAs, using your 401ks, or even HSA and flex spending accounts, it allows you to keep more of what you make because you're essentially saving money from your left pocket, which is your W-2 income, to your right pocket, which is your retirement account. And it's money you're going to have available to use later on. Tax loss harvesting. This is a phrase, I've seen this on YouTube, TikTok, Instagram, but it's a real thing. When you look at your investment account, we're looking at what are the stocks that you've had, some of which have increased, some of have decreased. And when you sell stock or when you have a higher level of income or you receive a stock grant, for example, what can you do to help reduce some of that positive income and taking some of the stocks that have actually gone down in value and selling those stocks can actually help reduce some of the capital gains that you have. So working directly hand in hand with your financial advisor and CPA, working together as a team, you're able to really help offset some income sources with some of the loss sources that you have. It's a strategic alliance that you have, and most people already have access to that. We're talking about timing, strategic timing of deferring income so that if you're in a year where you have a lot of income this year, is it possible to defer income to another year? 401ks is a great way to do that. Your HSA account, health savings account, is a great way to do that. If you have a business, have you completed the projects in the current year, or can you defer some of that income to next year so that you're able to pay tax at a lower tax rate because you have income next year rather than this year? The charitable donations is one of my favorite ways to reduce your tax. Number one, it provides a social benefit. There's a lot of charitable organizations that do tremendous good for all of us as a society, but it also gives us as individuals a great contribution and a way to reduce tax. A couple of things that can be done: a qualified charitable donations. Once you hit 73 and are required to make required minimum distributions, you can actually make your charitable donation to your church, to your whatever organization you want to support. And rather than taking the money and making the donation, it goes directly from your investment account. None of it becomes taxable income like it normally would. So it's a great way that a lot of people don't think about to reduce your overall income. We've talked about what happens when you receive stock options. Well, a lot of people keep those stock options. And when you have a lot of stock options that you've had on the books forever, you realized how much your company has grown in value, but you still want to make charitable donations. Rather than selling the stock and making that charitable donation, you can donate that highly appreciated stock directly to a charity. It never becomes income. and you're providing that charity with a great resource that they can use to do the good that they do. I mentioned earlier, when you have a business, the whole world of opportunity for tax deduction certainly opens up. The last item here, business-related strategies. This is one of the single most important areas where you can make deductions, where you can show expenses that somebody with a W-2 simply can't show. It significantly opens up the ability to take deductions that lowers your overall tax. I do want to touch base on self-filing versus hiring a tax preparer. Taylor had mentioned earlier, if you're somebody who has 2 W-2s, home mortgage interest, real estate tax, you have 2 dogs, 2 kids, TurboTax can be fantastic. It's a super inexpensive way to file your own tax return. You can knock it out quickly, and you're probably going to get the same answer that going to a CPA firm would have for you as well. The time to really hire a tax person like a CPA or enrolled agent is whenever you start having some complexity. Do you get stock options from your company? Do you have a small business? Do you have a side hustle? Are you contributing to your retirement plan? Or you start looking at, hey, I really want to reduce my tax. What can I do differently? That's what our firm does. That's how we help our clients. Like I mentioned, businesses give you far and away the single greatest ability to make tax deductions and build and grow your business, not only through tax deductions, but proper cash flow planning. That's a huge part of tax planning, cash flow planning, investment planning, and looking towards the future. But there's a lot of different options that a lot of people aren't aware of, including a lot of the new tax law changes that took place here in middle of 2025. That really takes care of our presentation. Josh, we truly appreciate working with Texans to do this presentation today. And I will turn it back over to you for any questions, answers. We'll go through any of the answers, but we'd love to hear any of the questions that everybody has as we've walked through this.
Well, thank you, Kevin, Brittany, and Taylor for being here today, sharing your knowledge and your time with us. Kevin and Brittany, if you really want to give a big shout out, I gotta call out the Richardson Chamber of Commerce's Leadership Richardson program, which is how Taylor and I connected. So that's one very fabulous, amongst many other wonderful things that's coming out of this program. I actually took some notes during the presentation for myself. And we do have a couple of questions, and I noticed some other questions going in the chat, and I wrote some of them down. So our first question is around, I think Brittany talked about this, the car loan interest. The question is, does the loan have to be started in 2025? And the follow-up is, what about an auto loan started in 24?
So the car loan, that's a great question. So the vehicle and the loan have to have been purchased in 2025. The other caveat that I didn't mention that is going to be important is it has to be manufactured in the United States. So one of the things that we're having to go through is we actually have a site. We have to request the VIN number and actually get confirmation as to where the final product was prepared, which, is great, but it just is an added thing that you have to think about when you're trying to take this deduction. But yeah, unfortunately, it does have to have begun in 2025.
Thank you. This next question's could be a little more complicated based on my knowledge, but you guys are the experts, so I'll let you say. So a participant retired in 25 and so can no longer contribute to any of the 401ks accounts from his former employers. His spouse re-entered the workforce last year, but was not offered a 401k option. They do not have a Roth IRA in place, and they're interested in understanding how to optimize tax benefits for their 2025 income.
That is a great question. And obviously, it depends entirely on your tax situation. But as you're re entering the workforce, you do have the option to make contributions to a retirement plan, whether it be a Roth, whether it be a traditional IRA. Depending on their source of income, there could be some other options that are available. But as most W-2 employees, the either Roth or IRA options are really the best source of contributions for retirement planning. There's other options. Definitely look into it based on your total tax situation, but those typically are the best options. Great question.
We got a couple of follow-up questions on the car loan interest that have popped up. First one is asking about a lease versus an actual loan, so a leased auto. And then the second follow-up is, what about taking deductions for a car loan that was started in 24, but they refinance it in 2025 or this year in 26?
Okay, great question. So the vehicle does have to be purchased. So a lease is not going to qualify, unfortunately. You do have to have a true loan on the vehicle. And then the second question regarding starting it in 24 and then refinancing, I believe it has to be a new loan in 2025, unfortunately, because it has to be a new purchased vehicle in 25, meaning the loan will have originated in 25.
Good questions, good catch.
Yeah.
Thank you for that.
I like the creativity of how we're thinking. This is good.
Our members are extremely creative individuals, which is one of the reasons we love them. Couple of questions I wrote down just to help clarify, because I've had these questions come to me and I have to tell people I am not a certified tax advisor or preparer. The only advice I can give you is you need to pay your taxes. That's the max I can give you there. Is can someone talk to IRS PIN numbers? Because I know identity theft is on the rise and that is a concern.
So there's a couple of things related to the ID PIN numbers. The IRS has been issuing PIN numbers. If there's a concern about identity theft or something dramatically changed, they will require that you have a PIN number. They will actually send it to you through the mail first. You can also request a PIN number and by logging into your irs.gov account. You would set up an account with the IRS. It uses verification through the ID Me, which is, I know a lot of people think, well, I don't want to register with the IRS. It's actually great. It provides additional identity theft protection. Nobody else can file a return using your name, claiming your kids, that kind of thing. And you just set it up through irs.gov. You can log in, request a PIN number, and again, your identity remains far more secure. It's a great way to go, whether you set it up or the IRS automatically issues that to you.
And one thing I want to add to that as well, from our perspective as preparers, is if you do have a PIN number, that's something we have to be provided to be able to file your tax return. Same thing if you're filing on your own on TurboTax, anywhere else. If you've been issued a PIN number, if we try and file your return without that PIN number, it will be rejected. It will tell us why, but it will be rejected. So just make sure if you do sign up, you get, to Kevin's point, you get a letter in the mail each year with a new PIN number. And this PIN number is individualized. So a husband and wife can both have PIN numbers. One can have a PIN number and not the other. So it's just make sure if you have signed up for this or have had identity theft issues in the past and you know you have this PIN number, just make sure you're getting the new one each year and providing it to your tax preparer.
Thank you. Question from our audience is for For business owners, is leasing a company car more beneficial than purchasing?
That is a question that we hear a lot. And it's not just vehicles, it's owning versus leasing a building, whatever the case. And the answer is it depends. There are certain situations where, for example, if you are enormously profitable, have a large net income in the business, purchasing a vehicle can give you a great deduction. Brittany talked about being able to write off 100% of the cost of the vehicle in the first year. That can be a great tax deduction, but it's not necessarily the best because it's based on your business. We look at the current year, last year, and next year to see, well, what is your expected income? What was your income? Where are you going in the future? Is it better to take the full benefit this year? Should we spread it out over a period of years? It also depends on the number of miles that you drive. I drive about 18,000 miles a year. Typically, leases are not beneficial for somebody who drives a lot of miles. If you're driving 10 or 12,000 miles, the cost may be more effective at that rate. So it really depends entirely on your situation. It's a great question and one to definitely delve into. As a CPA firm, that's certainly a discussion we have with a lot of our clients.
Thank you. I know we talked about in the presentation filing statuses, and we mentioned married couples and all that. And there are filing as single, filing as joint but separately, filing jointly together. But there's a fourth one that isn't really talked about, and it's always confused me, so I'm taking the time to ask this now. Can you define what filing as a head of household means?
Yeah, so as we walk through head of household, this applies to the easiest way to describe this, a single parent with a child. So if you are a single person, you can't file head of household, even though you are head of the house in your own domain. You may have 2 dogs and a cat. Those unfortunately don't count. If we see this with clients who are divorced, for example, who have kids, whereas I'm just going to use an example of one of our clients not too long ago. Husband and wife got a divorce. They had 2 kids, and they each have 1 child that lives with them. They each file as head of household because they each have a qualifying dependent and they're not married. Does that help answer your question as to what it means?
Sure does. And I kind of knew I couldn't qualify, even though I am the head of my own household of me and the dog. But done count as for this purpose. So
right.
Gotta ask.
Good question, though. I like that.
The one last question I have, because I think this will be our last one before we wrap up, is amending tax returns. That is something that occasionally has to be done, hopefully less often than needed. But what does that entail? What does that mean? Is there any major impact?
So I can cover that one. So amendments happen, right? Sometimes, say you have a K1 and you end up getting an amended K1 a year later or 6 months after you file your tax return, or, especially investment statements now, they'll send corrected 1099s a couple months later, and you're like, dang it, that's not my right income now. I've got to go do an amendment. Amendments they're not a difficult process in terms of the IRS doesn't think less of you for amending your tax return, right? That's always the concern. Like, what are they thinking? Oh, why am I amending this? They're going to look deeper into my return. There's a lot of confusion. At the end of the day, the IRS is just taking what they're being given and they're making the adjustment. The amendment itself shows the change to the IRS, and we have to provide a statement that says what's changing. As long as you're showing them what the difference is and why, they're going to process it as normal. The one thing to consider Because a lot of times what will happen is these amendments say they're going to give you a refund, right? And we think, oh, well, when I file my tax return, I get my refund within 10 business days, 15. Not with amendments. Because what happens, even though the amendments can now be filed electronically, they do still go through a different process with the IRS. It typically, like right now with the IRS, we're seeing 8 to 12 weeks. We're seeing people take even longer than that to get their amended returns on file and processed with the IRS. So keep that in mind if you are having to go through the amendment process. It's not that it's a bad thing. It's just, it is a different time frame that the IRS holds themselves to. But unfortunately, if you owe on an amended return, they do expect you to pay that tax immediately, of course, for the IRS, right? They're going to hold off on your refund, but they're going to make sure that you have to pay the tax now. So it's just something to be mindful of. It's not a bad thing. And sometimes it is necessary, right? The worst thing you can do is know that you need to do an amendment and not do it, right? Because then, to Kevin's point earlier, you might see a love letter from the IRS down the road that says, hey, taxpayer, you owe me X amount of dollars. And that may or may not be right? The IRS, they do have their systems in place, but just because they say it's true doesn't mean it's always true. So if you do ever get a letter from the IRS, I know this wasn't the question, but if you do ever get a letter from the IRS, don't immediately assume it's correct. It could be, but it also could not be. So I would always suggest checking with a tax preparer, like if somebody is preparing your return, send them the letter first and let them actually see if it's valid or not. Because we've seen people make payments to the IRS and then like give us a copy of the letter down the road. And we're like, I really wish you would not have paid this because it's not right. So just keep that in mind if you do ever see something from them. They make mistakes too.
Absolutely. Love letters. I think that's what I'm gonna start calling them now myself.
Yes.
Love letters. I like this term.
Term of endearment, of course.
Yes, of course. They love to communicate.
Yes.
And so before we wrap up fully, this is a text talk by Texans, so I'm going to tie it back to Texans in a way. So for those of you on the call who are listening later, Kevin, Taylor, and Brittany talked a lot of information about how to help you, how to get through this. You don't have to go it alone. There are plenty of professionals out there to help guide you if you feel overwhelmed. And same thing here at Texans. So the number one question I get as a financial counselor is, should I pay down debt or should I put it into savings with my refund if I get a refund? I always say that's up to each individual circumstance, but if you would like some more guidance, we're obviously here to help you. Texans does offer IRAs accounts here. So if you have questions, we can look at those for you. We also have some savings vehicles should you choose to put some money away for a rainy day. So we have plenty of different savings options for you. As far as protecting your identity, we do have credit connection feature in our digital banking. We also have a program called Doubly Uplift on our credit and debit cards, which can help you not only manage and monitor your credit, but if there is anything wrong or there's a problem, there's help available for you in the case of any fraud, which we always hope for no fraud, right? And then Evan talked about charitable contributions and all that. We actually do have a new feature called Roundup that's tied, so you can round up to your savings or you can round up to a charity. And then we have a gift giving center where members can give through their Texans accounts to a charitable organization that we partner with. So if that's something that seems beneficial to you, please contact Texans. Any other questions regarding 99% of tax, 99.9% of tax advice, I will say, please see a professional like one of these three lovely people who have joined us today, your own tax preparer, your own CPA. If you need help locating one, I will say chalking with your local chamber of commerce or a Google search can help you find a qualified licensed professional to do all that for you. So with all that, looks like you guys got a new screen. I'll let our guests do their outro before I finalize everything up here. Is there anything you guys would like to add on?
Thank you so much again for having us. It's a pleasure partnering with Texans, and we love working with you guys.
Yeah, absolutely. Thanks so much, Josh, and the whole Texans team. We really appreciate the opportunity to get to talk about this stuff, the stuff we do every day.
Yeah, thank you all for listening and being here. And if you guys do have any additional questions or feel like you need to kind of dive into some of these things we've talked about, please call us. We're here. I mentioned at the beginning, we love doing this. This is what we do every day. We signed up for it and we know it. And that's what we want. We want to be able to help and kind of guide, because taxes are scary. Taxes, like I said, create a lot of stress for people. So we're here to help. So anything you guys need, please give us a call.
Yes, and thank you all again. For those watching, it is very true. When I contacted them to talk about this partnership, they were so excited. And you don't really expect that when the topic is taxes. So it was very nice to have that energy flowing and, to create this wonderful opportunity for our members and our communities and everyone out there who may have questions that just need a little guidance. But again, thank you all. Thank you, Kevin, Taylor, Brittany. Thank you, Paul, for being my co-host today. And we look forward to seeing y'all in the next Text Talk. So please make sure you follow us on our social medias and keep an eye out in your emails for the next one. Thank you all. Have a great day.